Short pause. Short pause. The rate hold is not the story today.
Not even close.
Kevin Warsh chairs his first FOMC meeting right now, June 16th, and the press conference at 2:30 this afternoon could quietly retire the single most used pricing signal in fixed income, the dot plot. Gone.
Or at least reshaped beyond recognition.
And that's the part that got buried. Every headline this week is Fed holds at 3.5 to 3.75. Nobody's talking about what happens to the credit markets if Warsh kills forward guidance on day one.
He's publicly questioned whether the dot plot is useful at all. 247 Wall Street had a piece out yesterday asking exactly how markets react when they lose that signal. And it's not abstract. Capstone Partners reported that refinancing and repricing activity in leveraged loans collapsed in Q1 2026, a 22.5% year-over-year decline before Warsh even touched a thing. So the credit market was already stressed. Now you remove the anchor it's been pricing off of since 2012. The best deals are boring. This is not that. No. We're going to stress test Warsh's Greenspan-era philosophy against the reality of a $6.7 trillion Fed balance sheet he inherited. We'll look at the mechanics actually mean for SOFR-tied loans. Then we widen the lens. 10-year at 4.65, 30-year at 5.17, a GDP deficit running at 6.8%, and ask whether this communication pullback lands at the worst possible moment. And we close with the Reprice It round, 3 specific signals for credit desk watchers in the 72 hours after today's press conference. Walk me through the math starts now. Over $10 trillion in fixed income products have been priced at least partly against the dot plot's rate path projections since 2012. That signal may disappear at 2:30 today. And every headline you saw this week read the same way. Rate hold, 350 to 375%. New chair, smooth transition. Orderly handoff, maybe a slightly hawkish tone.
Markets move on. That version is almost entirely wrong.
Right. So the end money piece had this stat. 97.4% of CME FedWatch traders pricing in a hold, which, fine. The rate decision is as close to priced as it gets. Nobody's sitting on the edge of their seat waiting to hear unchanged.
What's the actual question then?
The actual question is what happens to credit markets when the roadmap goes away. The dot plot isn't just a signal, it's a pricing input. Mortgage desks use it, corporate bond spreads track against it, investment-grade issuers time their windows around where the dots cluster.
So remove the dots.
And you've removed the shared reference point. Every desk is now running its own model with no common anchor.
Which is great for people who think they have a better model than everyone else.
Yeah, and probably terrifying for everyone who is leaning on the Fed's model instead of building their own.
24 Wall Street put it clearly. For more than a decade, investors have had clues, not certainty. Clues, carefully constructed forward guidance designed to reduce surprises. That may be over after this press conference.
And the 2:30 presser today is where we actually find out. FX Street noted the June meeting is the one to watch precisely because it's a quarterly projection meeting.
Right.
Summary of economic projections, fresh dot plot, all of it. Warsh can reshape it all in one afternoon.
The rate hold is the headline. The dot plot is the story. So before we get into what this costs markets, who actually is this guy and why does he believe tearing up the roadmap is the right call?
That's what I keep wondering about.
So who actually is this guy? Confirmed 54 to 45, CNBC called it the most divisive vote ever for a Fed chair. Sworn in May 22nd, and today is his first FOMC meeting.
That vote tells you everything. Nearly party line. One Democrat crossed over. That's not a normal Fed transition.
And his stated philosophy has been on the record since the confirmation hearing. He said explicitly, I'm reading this directly, I don't believe that I should be previewing for you what a future decision might be.
Right there on the record. No ambiguity.
Zero. So the question I keep coming back to, where does that idea come from? Because it's not random.
Greenspan, full stop. LPL's rate and credit team described his target style as more opaque, less frequent, and deliberately ambiguous. He wants to run the Greenspan playbook.
Which is fascinating because Greenspan himself once told Congress, and I'm not making this up, that if he seemed particularly clear, they probably had misunderstood him.
That is the most central banker thing ever said.
The man was art. But August, here's what I actually want to press on. Was Greenspan's opacity a feature or a bug? Because 1987 happened on his watch. LTCM happened on his watch.
That's the real stress test of the thesis. Markets adopted to opacity then, yeah, but they also built enormous leverage on top of assumptions that turned out to be wrong. The opacity didn't prevent the risk, it just hid it longer.
And Warsh wants to replicate the communication style while simultaneously dismantling the tools Greenspan used to manage the aftermath, the balance sheet being the obvious one.
The Fed's balance sheet is sitting around $6.7 trillion, still more than 3 times its pre-crisis size relative to the economy. Warsh called QE reverse Robinhood. His argument, large-scale asset purchases widened the wealth gap and distorted where capital actually went.
Walk me through the tension there, though. He's criticizing QE as a distortion, but he also wants to emulate the era that made QE politically necessary in the first place.
Yeah, that's not a small contradiction. He's borrowing the aesthetic of Greenspan without the balance sheet to back it up. Completely different environment.
Which takes us straight to the mechanics question. If markets spent years treating the dot plot as a rate path and products were actually built on top of that path, what breaks first when the anchor disappears?
Short pause.
Short pause. So the dot plot isn't just a Fed communication tool. It's a pricing input. Walk me through the math.
Right. Every leverage loan in this country prices off SOFR plus a spread. That spread is calibrated against where SOFR is expected to go, which, for the past decade, the dot plot told you. 3-month average SOFR spread was hovering around 3.7% entering Q2. And if you pull the forward path out, if you remove the reference point, you're not just losing a hint, you're losing the anchor the whole spread calculation was built on.
That's not a small thing.
No, and Capstone's Q1 leverage finance report made this explicit. Without a clear rate path, market participants expect spreads to widen in the next 6 months. PitchBook already surveyed lenders saying private credit spreads could run 25 to 100 basis points wider. That was before Warsh's first press conference.
And the market wasn't in great shape coming in. Leverage loan activity in Q1 was running 34% behind last year's pace.
Right. PitchBook called Q1 the weakest start since COVID. Refinancing issuance fell over 40% year over year. The index itself posted a loss, worst opening quarter since 2020.
So here's what I keep coming back to. Was the market already pricing in the dot plot going away, or did it genuinely not do the math on this?
I think it's the second one. Spreads were tight into 2025, leverage was high, documentation was weak. The credit market ran borrower-friendly for 2 years on the assumption the rate path was readable.
Wow.
That assumption just got removed.
And now Blackstone and Cliffwater are both capping withdrawals from their private credit funds. Reuters reported redemption requests hit 10% and 17% respectively. This isn't theoretical.
No, it is not. The opacity Warsh wants at the Fed level lands into a credit market that was already fragile. 34% volume drop, widening spreads, BDC redemption stress, and now the forward rate signal goes dark.
Which means the Treasury market is next in line. That's a bigger number, and the fiscal deficit makes it a different kind of problem.
Exactly, and that's where this gets considerably more dangerous. And the Treasury market is a different beast entirely.
Much bigger, much less forgiving. Morgan Stanley flagged this back in February. Warsh's reduced communication likely boosts volatility specifically in treasuries. Their analyst said he won't always reinforce market perceptions if they differ from his own view.
So you lose the anchor. The 10-year was sitting at 4.65% when Warsh was sworn in. 30-year at 5.17. That's already elevated.
And steepening. Morgan Stanley's view is that a smaller Fed balance sheet pushes long-term yields higher relative to short-term. You get more curve steepening on top of rates that are already uncomfortable.
So, is that curve steepening already priced, or is it still a live threat?
Partially priced, I'd say. The 30-year briefly hit 5.19 in May. Markets know Warsh wants a smaller balance sheet, but what's not priced is the communication vacuum. The volatility doesn't go away. It just concentrates into sharper, less frequent spikes.
That's the mechanism I keep coming back to. Less guidance doesn't reduce surprises, it batches them.
Right, and now layer in the fiscal picture. CBO put the 2026 deficit at 6.8% of GDP. That's $1.9 trillion in issuance this year alone.
So Treasury is flooding supply into the market at exactly the moment the Fed is stepping back. Warsh wants a smaller balance sheet, which means less Fed absorption of that supply.
Which means private demand has to pick up the slack. Foreign buyers, pension funds, whoever.
And if those buyers demand more premium to hold 30-year paper, yields go higher. Not because of Fed funds rate, because of term premium.
Walk me through the math on that for a second. You've got the Fed pulling back from the market and shrinking communication, two sources of uncertainty hitting the same market simultaneously.
That's the structural problem. LPL flagged this in their analysis of Warsh's Treasury consequences. The combination of balance sheet reduction and opacity doesn't land in a vacuum. It lands into 6.8% deficit spending.
And that's before we ask what happens if Warsh also scales back post-FOMC press conferences, which he hasn't committed to keeping.
So tomorrow at 2:30, the press conference itself becomes the data point.
What he says, how long he talks, whether he even takes questions, all of it gets repriced immediately.
We've got someone sitting on a fixed income desk who's been adjusting their models in real time. That's who we need to talk to. So the FDI consulting survey, 73% of practitioners built their rate view around 2 cuts max. Fed funds ending the year somewhere between 3 and 4%. That consensus had a foundation, the dot plot. What happens to that number when the foundation disappears?
You rebuild it slower and with more buffer baked in. When I think about how a desk actually reprices, the spread assumptions move first because those are the easiest lever. Duration exposure is stickier. You can't just restructure a 3-year term loan overnight because Warsh went quiet.
Walk me through what moves first, specifically.
Floor assumptions on SOFR. If I can't see a credible cut path, I stop assuming the base rate comes down in Q3. That changes the all-in yield calc, which changes what spread I'll accept. That's the fast adjustment. Covenant structures, that takes longer. You're renegotiating docs.
Lord Abbott's mid-year data is actually interesting on that point. They're seeing new loans come with tighter structures right now, less leverage, more covenants, fewer PIK requests. But I'd push on whether that's a response to rate uncertainty or just a cyclical reset that was already due.
Honestly, probably both. And I'm skeptical of anyone who separates them cleanly. The Cov Light era ran long. Some of this is just reversion, but Warsh accelerated the timeline. When you can't model a cut, you want more protection in a document.
So the honest answer is desks are doing some repricing, but are they actually changing behavior, or are they mostly waiting to hear what you say at 2:30 today?
Dry. Let's not pretend otherwise. You don't restructure a book on a hypothesis. You wait for the press conference, you see whether he drops the dot plot language, and then you move. The repricing that's happening is at the margin, new deals, not legacy positions.
Which means legacy exposure to long-duration positions priced against the old dot plot forward path is still sitting there, unhedged.
Yep, and 57% of FTI survey respondents expect loan yields to widen. They knew this was coming. The question was always when. And now the when just became this afternoon.
That's the accountability question, isn't it? Who priced that risk and who ignored it?
And we've got a specific round for that coming up. What went wrong, who should have caught it, and what you'd do differently if you ran this book knowing Warsh was on his way.
So, accountability round. What went wrong?
The market spent 14 years treating dot plot projections as commitments. They weren't. Warsh's argument that forward guidance became a crutch, that's not crazy. The problem is the cure lands into the worst possible macro setup.
Walk me through the fault line.
Any credit desk pricing long-duration products against dot plot forward paths without a scenario for guidance removal was carrying model risk they weren't being compensated for, full stop.
And who should have seen it?
Everyone who read his published work before May 22nd.
Which is the job.
Warsh has been public about strategic ambiguity for years. BBH noted he said it explicitly during his Senate hearing. Fewer speeches, fewer press conferences, less prescriptive guidance. This wasn't a surprise. It was a scheduling problem.
So if you ran a rate desk for the past 2 years, knowing this was coming, what's the one thing you'd change?
I'd have stress tested every covenant package against a no forward guidance scenario before the deal closed, not as a tail risk, as a base case assumption.
Because the tail became the base.
Exactly. The 24/7 Wall Street piece from today put it cleanly. Investors are about to fly blind after more than a decade of clues. Kiplinger reported something sharp too. Today's press conference might be his last, given his criticisms of the format itself.
His last press conference, on day 1.
That's the structural signal. If he walks out of there today and implies the quarterly presser cadence is done, the market loses its next anchor point, not just this one.
So what's the specific watch item for anyone on a credit desk in the next 72 hours?
3 things. 1, does the dot plot survive, or does Warsh signal this is the last SEP in its current form? 2, language on dissent. 4 FOMC members dissented at the last meeting. If that number holds or grows, the committee itself is fragmented. 3, watch the 10-year move in the hour after the press conference ends. That's the unfiltered read, no spin, no analyst note, just where duration wants to go without a guidance anchor.
The 10-year in the hour after the press conference. Write that down.
That's your signal.
All right, if you made it this far, you heard what I think is the real story today. Not the rate hold, the dot plot.
Yeah, the rate hold is the headline. Warsh retiring the dot plot is what actually reshapes how credit gets priced from here.
And that moment we hit in the Reprice It round, the uncompensated model risk sitting inside long-duration positions built against guidance that may not exist anymore. That one stuck with me.
It should. Fast money desks can adjust at the margin. Legacy long-duration books, not so much.
The Greenspan playbook in 2026 with a $6.7 trillion balance sheet. Let's see how that lands.
Right. The stress test writes itself.
New episode every Tuesday. If this one changed how you're reading the Warsh era, send it to someone who still thinks this week was just a hold.
Subscribe wherever you listen. Blake, thanks for the reps today.
Always. We'll see you next week.